So there's been a ton of hype in the news around interest rates and the changes coming in on May 1st. Now, Tyler the Home Loan Guy here, and I want to break down the changes and give you a little bit more insight and put out the facts of what is actually changing. So first off, this is not a new change. This is old information that has been already implemented by pretty much every lender in the nation. The May 1st date is based on when the mortgages are sold to Fannie and Freddie, not when they're originated. So everything that's been originated in the last couple of months already has this change already implemented in. The other thing to think about is this is only normal, conventional, conforming loans. So this is Fannie and Freddie type stuff. If you have an FHA, VA, USDA loan, it is not going to be affected. Also, if you already have a closed loan or a loan that's already been locked, it is not affecting you either. So anybody that is already in their house, already purchased their house, it is not going to affect existing mortgages. Now, the media has done a really good job of jumbling up all of the information of what's truly changing. So I've seen articles that say that there's going to be a 1% fee for anyone that has a 740 credit score or above, and it's going to be a straight 1% fee on the closing disclosure for to offset the risks of a lower credit score buyer. This is also not true. This would be very similar to, let's say, uninsured motorist coverage on your insurance policy for your auto insurance. This is not going to happen either on a closing disclosure. Again, we've already implemented these changes, and those fees are not showing up on a closing disclosure as a separate line item, which is what is being said, a separate line item that says to offset the risk of lower credit score buyers. That's not true either. I've also heard that someone with a higher credit score is going to have a 1% difference in interest rate, not only fees, but also an interest rate. So someone with a higher credit score is going to have a 1% higher interest rate than someone with a lower credit score. That is not true either. So then what is actually happening? So what is actually happening is Fannie and Freddie are changing the LLPA requirements for basically the entire table. But basically an LLPA change, it changes the cost to get an interest rate. It doesn't necessarily change the actual interest rate. At the end of the day, rates have always been and will continue to be risk-based, and these new changes don't necessarily remove that same thought pattern that rates are going to be risk-based. Rates will still be determined based on a risk profile, and which means that 740 credit score or just people in general with good credit will still have a much better interest rate than people with lower credit scores. And also, they will still pay a lot less fees. Someone with a lower credit score will still be significantly higher in fees, and also will most likely have a higher interest rate than someone with a higher credit score. And one thing that no one's talking about is mortgage insurance and how mortgage insurance plays into all of this, and also different loan programs that have come out and the different qualifications for the different loan programs at different LTVs. And also the mortgage insurance is going to have a major impact and always has. This is not changing mortgage insurance and how that's calculated, but mortgage insurance plays into a really big factor in choosing what the best loan program for the buyer is. I've tried to keep this video short, but obviously we didn't cover all the details of the change and the true impact of what's going on. And I've tried to keep my own opinions out of this video as well. If you have any questions, feel free to reach out anytime. I'm always available.